there's been a divorce between reality and what's on the financial statements. We didn't abandon value. We said we could probably do it better. You're getting this stuff cheaper than it's ever been. It's never been cheaper. We have this habit of calling value, but in reality, what we're really doing is valuation. We're looking forward and trying to identify not just the asset is cheap, but that in the forward looking, it's going to go up in price. You're saying what companies can produce a lot of money and not take a lot of risk, right? And you can think of it that way, and that's how we measure quality. That's the way we think about product design all the time. It's not about saying that everything always has to be used. It's not about saying this is the best. It's not necessarily the best. It's what are you trying to capture? India's electronics exporting business would need to grow by 6 times just to capture 10% of China's market share. There's no way they could physically do that, right?
Hi, Warren. Thank you very much for joining us today in Excess Returns.
All right, thanks. Thanks for having me. Appreciate it.
You lead portfolio management for GMO's systematic equity team, and we've had the good fortune as well as having your colleague Ben Inker on. So it's always fun and I think insightful for our audience to hear and learn from the folks at GMO and what you're working on and sort of just the knowledge and the research that you kind of share with the world and your investors. So today we wanted to have you on to dive into your systematic investing process, things like how you define value in today's market, what you're seeing maybe in the deep value cohort of stocks, and also get into some of your other research on international markets, maybe talk a little quality, ESG, and a bunch of other stuff. So that's kind of the lay of the land for today. So we're looking forward to it.
That's plenty to cover. I'm looking forward to it.
So let's start with value investing a little bit, because it's been kind of a rough 10 to 15 years for value, to say the least, maybe. But I mean, what are the biggest lessons you think investors can take from this 10 to 15 years of relative underperformance?
Sure. I mean, it's been difficult, right? So, I think the thing that I've learned, maybe my team has learned, is like your theme can always struggle, and these themes can last a long time. The struggling can last a while, but you could always improve inside your theme, right? Like a lot of the work we've done in our valuation process has been during the worst times when value's been really killing it, getting killed, and so we didn't abandon value. We said we could probably do it better. And I think that's the lesson, when we look at all the things that we've done over the last decade, as you kind of said, probably a little bit longer than a decade at this point. But we've made things so much better, and we've actually made a difference in our process and gotten better results for our clients. But that's the thing that you have to do. You have to have that same level of, it's easy when things are doing well, right? It's actually you work the hardest when things are performing badly. And you have to continue to improve on that. And that's really the lesson I think I try to impart on my team, right? It's like, you don't abandon your theme. You don't abandon what you're good at. You don't abandon what you believe in. Instead, you try to improve it. And that's really that's the lesson that when I look back at my career, like when value's done great, it's been great. You make it better. When value's done poorly, your process is the same. Make it better, right? And I think one thing I should say, we do the same thing that you're saying. We have this habit of calling value, but in reality, what we're really doing is valuation. We're looking forward and trying to identify not just the asset is cheap, but that in the forward looking, it's going to go up in price. So that's a little bit different, right? And so that's a key thing from what I think about things for both the two value ETFs we run is we're looking at the valuation of these going forward.
Can you sort of define, let's shake that out a little bit more, like walk through that process of how you guys go about doing those buildups, those valuation buildups?
Sure. I mean, if you think about value of what the market defines it as, it's things that are just cheap today, and mostly historically, looking. What you end up with is, these are using reported, financials. These are filled with value traps. They're filled with junky securities, and they completely ignore kind of, future growth and the like. Within our valuation process, we try to account for a lot of these things, right? And I think that's the biggest difference you start with there. The first thing we start with is just the inputs themselves, right? The raw financials, right? If you look at the balance sheet, income statement, cash flow statement, that's what you start with, the raw fundamentals. And what we found is for value, not just for value stocks, for all stocks, you have a problem that's happened over time where there's been a divorce between reality and what's on the financial statements. And so what we've done is we've actually restated all the financial statements for every single company to account for these perversions that we think are out there. And I'll just give a very simple example of that. If you have a company, two companies, one company is a serial acquirer, right? They're buying technology, they're buying brands, they're buying patents. All of that's going to show up on their balance sheet, right? It's called goodwill, right? Something that's there, it'll sit there, it rarely goes off. Every once in a while, they'll impair it and whatever they will do. But you have another company, same type of company, but they've just done it organically. They've just done the R&D, done the work, and they haven't bought other companies. Their balance sheet looks completely different. None of that's on their financial statement. We make that adjustment. We go through and depreciate and restate the R&D, advertising, all those things to account for those items. Right? That was a massive amount of work. That goes back to the first thing I talked about when you asked me, what have we learned? We did that work, about a decade back when things were doing badly for value, and these are things that are helping us today, right? But now all we've done, and I say all we've done because and some members of my team will kill me here, but all we've done is we fixed the inputs. That's it. The inputs that go into your evaluation process are now more relevant and more comparable. So back to your question is like how do we define value? I think this is where the definition of value hasn't changed, right? The definition of value is the fundamentals that you care about, right? You model those and you find things where the market isn't pricing in those fundamentals, and those assets are cheap in your mind, right? The key thing here is that you have to maybe do it better now, right? Because things are different. Like it used to be old bricks and mortar. You're measuring how much is this factory worth, how much is building worth. It's very easy. How much is a brand worth? How much is a patent worth? Right? Those are things that it's the same thing mathematically. It's just more difficult to do. Right?
Well, and much more of there's intangible assets are a much higher level of value, I think, today than they were 20 or 30 years ago. So that's sort of what you're getting at with those adjustments, right?
Absolutely. Absolutely. I mean, like I said, the math is no different, right? We're still trying to figure out what is the company worth, what are their assets, how efficient are they, leveraging those assets from a profitability standpoint. And that's why I say when I said we're fixing the inputs, if you can't even measure the assets correctly, what does it matter what you're doing everywhere else, right? I go back to, we have examples in a lot of our marketing decks about like Apple, right? Apple, everyone knows it, so we use this as an example. But they don't have a lot of those things on their balance sheet, right? They've grew a lot of this stuff organically, right? They're not buying, they do acquisitions, don't get me wrong, but it's not a big part of their business model. So how do you deal with that, right? And those are the adjustments we make to make things more on an apples to apples. I can't believe I just said that. An apples to apples comparison, right? That's what we're doing. But and that's just to deal with the fact it's an intangible asset. How do we make an intangible asset tangible, right? And that process. So in my mind, I said I don't want to make it sound like value is any different today. It's just the way you get about it has to be different. Value is no different than it was 20, 30 years ago. The valuation, how you go about it is no different, but it's just the nuances and the details that matter there.
So if I understand, part of the process is this bottoms up, valuation analysis that you're doing. But then, and I'm kind of going to go to the ETF now, the GMO US Value ETF. There is this top-down, I guess, approach or overlay where you're trying to identify where the biggest value is, right?
Yeah, sure. It's actually kind of in two steps. You can think of it this way. In GMO, we've always been focused on searching for assets that are effectively cheap, right? Things that are cheap based on our valuation criteria. Our asset allocation team is extremely well known in this regard, right? Back in 2020, they found a dislocation within the value universe. And what they found after a lot of research was, yeah, value stocks are cheaper. That's always true. That's not uncommon. Value stocks are probably cheaper than average at that point, and that's great. That's also true. But if they broke down the value universe into the parts and segments, what they found was the cheapest portion of the value universe, the bottom, the very bottom, or very top, depending on your perspective, the very bottom was trading at an abnormally cheap rate versus its own history. And we call this segment deep value. And additional research we did showed that this is something that was a unique opportunity. And back in 2020, we started a long-short version to take advantage of this phenomenon. And in 2024, we started the long-only versions in ETF form, the US Value ETF and the International Value ETF. And that's the top-down view. Now, once the asset allocation team has figured out that top-down view and said, this is a very interesting phenomenon, can we capture this? That's where they come to my team on the equity front and say, how do we capture this in the best way? Now, when we first looked at that grouping of stocks, I said, holy smokes, these are awful stocks. There's some terrible junky value traps, like things that you don't want to own, purely. But when we dug into it, we said, well, there's lots of stuff in here that we do want to own. So how do we distinguish that? And that's where the whole valuation process we talked about earlier comes in, right? Within this universe, we can distinguish, higher quality companies. We can distinguish or mitigate the value traps. Our valuation process can deal with those issues and say, and what we've determined is this portfolio that we created, both in the U.S. and international, can get us that exposure to that deep value, which has never been cheaper, right? In the U.S. and international, it's been cheaper 5% of the time or something like that, right? But it's extreme levels. Yet we're not going to just give you all the hair and junk in that section. Right?
And are we still where are we today in terms of rank and cheapness historically?
In the U.S., it's never been cheaper. I think in international, it's just slightly, in the top fifth percentile or something like that. So we're talking really, really, unprecedented levels, both in the U.S. and this is developed international, by the way. Mm-hmm. This phenomenon we're not seeing this phenomenon in emerging. Emerging value itself looks cheap, but if you break it out, there's no clear distinguishment there.
And what's interesting, and we'll put the chart up here, but if you look at all the different quartiles, I don't know the exact data this chart is from, but all the quartiles except for the bottom one are expensive. Even shallow value is expensive. So growth is expensive, mid-growth, extreme growth, shallow value, they're all expensive. It's just these cheap stocks that are extremely cheap.
Yeah, if you put the chart up, I mean, we're using pretty standard value criteria here to break down the different parts of the universe. I think the interesting thing though is just you look at the level of the bottom line and just how low it is historically. And that's really, like I said, that's the phenomenon our asset allocation team found, right? That's the original top-down research, Justin, that you referenced earlier, where they're scouring the world for this stuff all the time. This stuff doesn't happen all the time, right? But when it does happen, they're going to find it. When they find it, we're going to take advantage of it for our clients.
And this is after adjusting for intangibles, right? So you can't make the argument that intangibles are the issue here.
All the numbers, the criteria. One of the criteria we put in here is actually, instead of price to book, we use price to our economic book. After we've included all those things in there, yes.
How do you if we think about the struggles of value in the past decade, how much of it can be explained by this? In other words, once you adjust all the data, are the struggles a lot less in the past decade than if you just use like a traditional price to book?
Think about it from the layers of, you have generic value, like generic value, price to book, price to sales, price to cash, whatever you want to use there, and you have a performance of that across various universes. It's been relatively poor, right? As you said, relative to the overall universe. If you take what we've done to fix the inputs, so to speak, you see a gap up in performance. If you take those inputs and put it into the valuation process we have that adjusts for quality and things like that, there's another gap up in performance, a substantial gap up. So certainly some of that can be mitigated. I would say, value is a headwind. Oftentimes I tell my team, we're trying to survive, right? If value is underperforming by a lot, if we, match the index, we're probably doing okay, right? So I don't know if it fixes the problem, but it certainly massively mitigates the problem. Is probably what I would say.
With the ETF, will you own the other quartiles if they become cheap? So, I mean, this will probably never happen in my lifetime, but maybe someday extreme growth will actually get cheap. Would you consider owning that, or do you really want just the cheapest stocks?
Well, if the other quartiles get cheap, they wouldn't be the other quartiles anymore. So almost definitionally.
Or cheap relative to their own history,
right.
I guess was my question.
Not the way we have it structured right now.
Okay.
Right. Not the way we have it structured right now. I think in some sense, though, you could think about what our top-down view might change, though. There might be a different opportunity somewhere else, and that might be where the value is, and we might go there. So I wouldn't say we would never do that. I would say if the opportunity was somewhere else, certainly we would be open to changing the strategy to going to where somewhere else is. Right now, it's just, and maybe our mindset is so short-term in some ways because we see this as such a great opportunity. We're so focused on this one, right? But certainly if something else changed, if quality stocks, for example, got very, very cheap, usually they trade at a premium. certainly that's an example where we might look at that as, well, that's where the value is today, right?
How do you think about incorporating quality in your process? I mean, it seems to me like it's one of the harder things for just your average person or for even factor investors to define. And everybody seems to define it differently. Like, how do you think about quality and defining it?
Well, first of all, my experience with quality is everyone does define it differently. So that's the first thing. I think the important thing maybe for us is to start with our definition, right? We think of it as very simply companies that generate high sustainable return on capital. That's it, right? But for quants, which we are, what does that translate to as far as how do we measure it? We're looking for companies that have high levels of profitability, in various measures, stable profitability over time, right? Can they continually create this profitability year after year or year after year and then the like? And finally, really strong balance sheets, especially from a leverage point of view. So if you put those three together, you're saying what companies can produce a lot of money and not take a lot of risk, right? And you can think of it that way, and that's how we measure quality. I know the market defines things, everyone defines that very, very differently, but that's how we define it. Now, we feel that quality should be part of your valuation process, though, right? If you put it simply, and you can model it different ways. We've tried different ways of putting it in as far as the end rate on your dividend discount process or whatever it is. But effectively, what happens is you want to reward high quality companies with effectively a premium, and then low quality companies get a discount. You need to get paid more from a discount or value point of view to buy that low quality company. And that's effectively how we blend it in to the process. So we blend it in like 3 or 4 different ways, don't get me wrong, but that's effectively what happens at the end of the day.
Do you use momentum at all? We talked to a lot of value investors and some don't use it at all. Some use it for entry and exit. Some use it as a secondary factor. Like, do you use momentum at all with value?
So it's a little bit different. For these two value ETFs, these were top-down kind of dislocations we saw in the market, and we wanted to keep the exposure to deep value very pure. So we don't use momentum as a direct factor. Now we do monitor it and try to minimize the exposure, especially when the correlation between momentum and value change pretty aggressively at times. But we do use momentum in our core products. But see, because this, once again, we think very carefully, what are we trying to fundamentally capture? In these two value ETFs, it's all about that deep value component. How do we get more there? If you put momentum as a direct factor in this product, what would happen is you'd be minimizing or you'd be diluting the amount of deep value exposure you have. And that's something we didn't want. So we don't directly use it for this product. If we get to the Beyond China, it's a completely different story. We do use it quite aggressively there.
Yeah, and it's interesting because people, I think that's a misconception people have about factor investing. They think, there's the right way to use it and the wrong way to use it. Well, a lot of it is like, what is the goal I'm trying to accomplish with this specific thing, and how do I use it here?
Absolutely. That's the way we think about product design all the time. We're designing. It's not about saying that everything always has to be used. It's not about saying this is the best. It's not necessarily the best. It's what are you trying to capture? And this is where we work really closely with our asset allocation team. Like they show us all the research of what they're finding from the top-down point of view. They're saying this is what we want you to capture, and then they give us unreasonable expectations about alpha, and then we kind of go ahead and do that. But that's, am I joking? All joking aside, well, that's the conversation. We're pushing each other. The teams are pushing each other to get the best thing possible. So we talked about momentum when we designed the product. We said, hey, this would be great in some ways, but then we looked at it and said every momentum point we put in there decreased the deep value exposure. Why would we want that? Right. So we do monitor and we do control for it in the risk process, but not as a direct factor. Back to your original question.
How do you think about ESG? This is something that's been a huge debate. I mean, we went through a world where people were saying, I can get better returns and I can invest in great companies and do good for the world. And now we seem to have gone completely in the other direction. But how do you think about ESG as a factor, and specifically how it relates to maybe boosting returns versus just doing good for the world?
I think it's unfortunate what happened to ESG because it got politicized and the like. My view on ESG has never changed. My view on ESG, it's always been from an investment perspective. So the whole do-gooder, like you have to do this because it's the right thing to do, is great. If you want to do it, fine. But that's never been the way I've thought about it in my career. And I've been using ESG factors for 20 plus years and the like. So I think the internal debate is more whether the ESG factors are risks that you need to be managed or whether they're sources of long-term alpha, right? I think that's more of it. So either way, it's an investment perspective, right? So for our strategies, we typically incorporate it as a risk. So we have a proprietary ESG score that we calculate. It's internal to GMO. We spend a lot of time researching this and the like. And we actually manage it at the portfolio level to ensure that there is an excess exposure to, high or poor ESG names within the portfolio.
How about macro factors? I mean, we're obviously living in a world right now where macro factors are right in front of us every day. We're at higher inflation than we used to be in the past. Does any of that matter in terms of how you construct a portfolio?
For the value ETFs, the short answer is no. It's a very similar argument to what we just talked about for momentum. The desire to have that pure exposure to the deep value theme. It just felt like if we put the macroeconomic factors in for the internet, and this is more for the international ETF, it just seemed like it would just dilute that deep value exposure. Now, I know we haven't talked about Beyond China yet, but for Beyond China, this is one of the key factors, right? We're trying to determine how strong or robust are some of these emerging markets in Beyond China. And if you don't use macroeconomic factors, you're in a world of hurt, right? You're going to be in a difficult situation. You need to understand the nuances of how well the administrations or the governments are doing with the finances, how many of them are, just giving away the farm and going to have that inflation and current account issue later on and all those things. So, but certainly on the value ETFs, we don't use them directly. We do, once again, it's about product design. It's about designing the product to capture what we're trying to capture. And macroeconomic factors work and are needed in certain places, but not for the two value ETFs.
So it's not part of your process, but do you have a view on value related to inflation and rates? I mean, some people will say it makes logical sense that, with high rates and high inflation, value should do better. But then some people look at the data and say, maybe the relationship's not that strong. Do you have a view on that?
Not particularly. I think there's not enough observation points. I think the problem with that kind of study is like, how many observation points are you really looking at? People say like, I have, 20 years of data. I say, no, you actually have like 3 observation points. so in my mind,
it's kind of like the yield curve inversion, right? The same type of thing. Like how many yield curve inversions have there actually been?
Yeah, you've gotten it. 5 out of 6 have happened. I'm like, well, that's great, but you have 6 observations, right? No legitimate quant would sit there and say, well, I think 3, 4, 5 observations are all the same bucket, like very few, right? So I wouldn't say I mean, value investing will work. What the catalyst will be, nobody knows. Right. I'm not going to try to pretend to say I know what the catalyst is. I do know that we do it really, really well. And I do know that it's abnormally cheap today, especially that deep value segment. Right. So that's what we're trying to say is like for clients and people, we're not saying that next year it's going to happen. Oh, high rates are going to cause this to happen. And they're like, we're just saying you're getting this stuff cheaper than it's ever been. It's never been cheaper. Right. Or better valued. Right. So from that perspective, I don't put too much onto that forecasting of rates and things like that. So
how do you think about concentration when you build portfolios? On one hand, we want to have as much exposure to the factors as we can, but on the other hand, we need some degree of diversification. So how do you think about that balance?
Maybe I'm greedy, but I think I can have my cake and eat it too. Honestly, because we're in the cheapest part of the segment. We're not talking like 20 stocks, right? So the cheapest, the universe is very, very large, and even the cheapest part of that is 15, 20% of that. So it's not as if our universe is very small, even in the deep value segment. So I do have my cake and eat it too. I mean, the U.S. product has 160 plus securities, the international product close to 200 securities. So diversification is really not an issue. And so that makes it, if it was something where I'm saying I want the deep value portion of a small country, that would become more of an issue. But because we're operating off the entire global universe or U.S. universe, it really doesn't become a problem.
How about position sizing? A lot of quants will just say, I'm going to equal weight it all and I'm going to move on. And just looking at your holdings, I don't think you do that. So how do you think about position sizing?
No, I think equal weighting is a weird thing. I think it's a little bit of a cop-out, honestly. But, our sizing is really determined by the attractiveness based on our valuation process, right? If our valuation process runs and says this is the cheapest stock or this is the best valued stock, we're going to attempt to put a bigger weight on it, all else equal, right? Obviously you have liquidity issues, you have sector, country, industry concentration issues and things like that. But we're going to rank all the stocks in order on how attractive they are based on our valuation process. And we're going to attempt to put the biggest weights starting from the top and going down. We feel this delivers the best result for our clients. And once again, going back to your previous question, we're not sacrificing diversification. We have 150, 200 stocks in these portfolios. It's not as if doing that is buying the 10 stocks and we're done with it. We're not doing it that way. So certainly that doesn't become an issue. But that's the way the sizing effectively works.
You mentioned sector concentration. How do you think about that? I mean, you have some quants who say, if I love a sector, financials or something, I'll have 40% of my portfolio in it. You'll have others who say, I really want to stay pretty close to what the sector concentration of my benchmark is. How do you think about that?
For these value ETFs, we want to get the theme. And if the theme happens to be more in a sector, we want to give it some flexibility. So we actually have modest constraints at the sector level, about 5% on the overweight side. For the countries and names, we tend to be more narrow. We don't feel that there should be a permanent, like massive bias to a country or a massive bias and we want the stock to be spread out more. So certainly there is a little bit of difference there as far as we do it. Now, one of the things that we do here is all of our constraints are only on the overweight side, not on the underweight side. And once again, that goes back to the thinking, like, do I want to be forced to buy 5% NVIDIA in this portfolio? Because I have a name limit of whatever, 2-3% and the like. Like, no, that doesn't make any sense. So we've actually constructed the portfolio and the constraints to match kind of what we're trying to capture on the theme.
How about rebalancing? We've talked to some managers who, have a scheduled monthly or quarterly rebalance. Some people are doing it every day and they're making just small adjustments. Like, how do you think about that?
I don't think there's one way to do that. I think either way can work really, really well. You have to match your alpha, or your expected alpha or your valuation scores to your balance. I think that's the main thing. Is like, what is your raw factor doing or your raw models doing, and match the valuation models to that. Now, if you had intraday factors that were updating daily and that had high turnover, then you need to trade every single day. You're tweaking everything. Back to your example, Jack. But I mean, this is the deep value segment of the market. Now, they do move around, but not all that much, right? Turnover tends to be about 50% per annum. It's not very high, relatively speaking. So we typically look to rebalance all the time, but we end up rebalancing pretty much on a monthly basis, right, to capture that. It's just about aligning what you're producing in the research. You're aligning your rebalance schedule to capture that the most efficient manner, right? Right. If we rebalance daily, it wouldn't help us that much because what we're producing on the research side is something that moves slow.
And when you do that, what you're doing is you're looking at your factor scores and then you're weighting that against like some sort of turnover. Obviously, you don't want to have, if something falls just barely above your threshold or something, you don't want to have, 200% turnover or something like that.
Oh, we're quants. We have everything in the world. We have turnover frontier, cost frontier. We have, I can bore you.
Big screens in front of you in the office with all of it.
I can bore you to death with all of those things. And people talk about the fact we're picking up X alpha for X turnover and X explicit costs. And then, once you get the traders involved, then it all breaks down. Then it gets crazy. But certainly, and I think the short answer is though, we want to make sure we're picking up the right amount of alpha given the cost. We're very sensitive to the cost of trading. But once again, you have to match what is your alpha doing? How often does it change? How often do these stocks rotate out or into your universe, right? And then, like I said, our rebalance schedule tends to be, ends up being on a monthly basis just because it's a slow-moving factor.
Yeah, I've always wanted to do like an in the weeds factor investing podcast where we dig into all that, but like 3 people would watch it. So we have to we can't go like completely in the details. Like I'm sure you and I would both love to.
I think we spend a lot of time on those things, and that's why I kind of joked about it. But we do spend a lot of time on those things. Yes, I'd watch it.
Oh, good. Yeah, you and me. My mom always watches my stuff, so she wouldn't understand it, but she would watch it. But I want to get to a broader issue here we've talked about a lot in the podcast, which is we've had Mike Green on the podcast. And I don't know if you are familiar with his work, but his work is around the idea that passive investing is having an influence in the market, and that as more people are investing passively, as the default option at 401ks becomes these market cap weighted indexes, this is having an influence in the market, and it's driving up the bigger stocks relative to the rest of the market. And this is sort of a structural factor that's at play here. And some people have argued, like David Einhorn talked about it in a podcast, that this is impacting, like if I own a small cap stock and good news comes out about the small cap stock, it may not go up like I thought it would because there's less people paying attention because everybody's in these market cap weighted indexes. So I'm just wondering if you have any thoughts on this in general, like the impact of passive investing on the market and how it might impact what you guys are doing, if at all.
In a previous life, I used to manage passive investments, so this is kind of near and dear to my heart. I don't think passive investments can distort the market in the short, medium run because flows move into it. But if you think about what passive investing really inherently, all index funds are price takers, right? They don't care if it's expensive. They don't care if it's cheap. They don't care if it's at $1, $2, $10, $50. I mean, the only time they really care is when you're dealing with Berkshire Hathaway because they can't buy half a share, right? So, I mean, that's the only time they care. So when I think about that, I actually think maybe they distort the market in the short run because like a bunch of money flew into this ETF and suddenly something happened. But what will really price every asset is really all the informed investors, right? The investors that have information they're trying to battle, right? They're battling out back and forth, the selling and buying, and that's the long-term value or price of the asset, right? Because index funds won't be doing that long term. Because long term, this is whatever flows go in and out. They'll just take whatever price is there. So, in my personal opinion, the less number of informed investors there are in the market, the better it is for us. That's my opinion. I mean, it's just there are less people fighting over the same alpha, and the like, and that's not a bad thing for us. I think that's a great thing for us. When people like, take it to the extreme degree, and this is the example that somebody mentioned to me a long time ago. Imagine you were the only active investor in the market. You're the only one, nobody else. 99.9999% of the market is passive. Is that good for you or bad for you? That's great for
Yeah.
you, right? So I know that's a very extreme and ridiculous example, but if someone says indexing is going to be 80, 90% of the market, and I'm still the active investor out there, I, I'm happy about that.
But there is that concern people express that if passive gets too big, you could have problems with the overall market, whatever it is, whether passive flows reverse or something like that, or, there is a point where it gets too big. And I don't know what it is right now, 40% or something like that, but
So I was
there are
talking
concerns around that.
Yeah, I was talking about the pricing of the assets. Certainly, there can be a systematic concern, right? If someone decides in passive investing, there's a big so the cash flow, the money flow kind of argument, right? In the short run, it could cause a systemic problem, and certainly there can be scenarios where you can see that. But if you're just thinking about like what are assets going to get priced at, how are you going to identify cheap and how's cheap going to get to fair value, and the things that we care about, the more passive investing there is, the better, I think.
So I want to put up this chart. This chart is looking at stocks and bonds and looking at international and U.S. I think you're familiar with from the outline what we're looking at here. Can you just talk a little bit about what we're seeing here? Because I think this is pretty interesting information about the valuations and everything across the different regions.
Sure. What you're looking at is a 7-year forecast that our asset allocation group puts together across various asset classes. This is a very small subset of what they actually model, and this is kind of the way you should think about it is this is the type of research they do all the time to try to identify those dislocations. Now, these are broad asset classes, but the same type of work went into calculating, the expected return for deep value. And you see that as one of the numbers, one of the items there. The USD value is, I believe, the third set of bars from the left-hand side. And you see there the expected return based on our 7-year forecast there. So what we're seeing there is that in the U.S., deep value is so much more attractive than everywhere else in the US. Now, the US versus other places, like in international markets, even deep value, honestly, probably doesn't even, some places are great, but some places there are other more attractive places, international and even emerging to go to. So I think this is a good example and a good illustration of that top-down view that we take first with our asset allocation team, where they're looking across all these different asset classes. And for each one of these, they're trying to break these things down. Like, where is it coming from? Why is EM at 6% now? What part of EM is at 6? Is it value that's higher? Is it growth? What part of that? And then even there, we don't show it here, I don't believe, but they break out EM without China, EM with China, like those types of items to find those dislocations. And that's the kind of work we're doing all the time, right?
Yeah, it's really interesting what you pointed out. The difference between U.S. deep value and everything else in the U.S. is so different than it is internationally.
Yes.
Deep value is cheap internationally, but relative to everything else, it's not as cheap as it is. The U.S. is so pronounced.
It's been that way for a while in our forecast, right? So, and certainly from a valuation point of view, even some basic multiples you look at, the U.S. has had that premium for a while, and that premium has grown. We certainly have suffered because of that, because we've taken an underweight to the U.S. But our point there is that, like, fundamentally, we still view other places as attractive. Now, the deep value idea allows us to get into the U.S. though, right? It allows us to invest in the U.S. and say, hey, at 5.9%, I'm good. Like I can. That's very comparable to a lot of the other places that are attractive internationally, and I have a position in the U.S. market, right? But once again, this is all the work that goes into that, right? How do you break up the little parts to say, how can you find something that's attractive in an area that is not attractive?
Do you see any parallels between what we're going through right now in the dot-com bubble? Like some people say it's completely different and these are way better companies. Some people say it's exactly the same and you're seeing this overvaluation of large companies. Do you have any feelings on like comparing and contrasting those two periods?
This is back to the observation points, right? The number of observations being low. I think we all lived through the dot-com bubble. It was extreme. We're talking pets with sock puppets being worth billions of dollars and things like that. And certainly you're not seeing those types of things happen. There's always comparables though, right? There is a euphoria, whether it be AI or whether it be, cryptocurrencies and things like that. There is an extra euphoria that you probably haven't seen since the dot-com days. Will it happen the same way? No bubble's the same. Every bubble is different, and every bubble bursts for different reasons, right? What we do and what we try to do is just identify those bubbles and see that there. The U.S. market is, whether it's in bubble territory or not, in your definition of bubble, it is very, very overvalued.
Just going back to the bar chart for a second. So in international deep value and I guess emerging value, are there any countries or any sectors that sort of jump out that's driving that? Or is it just kind of pretty diversified and spread out? I'm just curious.
I mean, it's pretty diversified and spread out. Certainly in emerging, you have certain countries that are more expensive. I think India is the classic example where
Right.
it's very expensive. It's actually gotten up until some this year. It's given back some this year, but up until this year, it had been trending pretty highly, even from expensive valuation to really expensive valuation. But not in developed so much. In international, we do see that kind of spread out. We do have certain countries we find more attractive, but not from a massive dislocated point of view.
Yeah, I
I'd
guess-
say, yeah, I'd say emerging is the
Europe
place you
pretty
see it
cheap.
more.
Yeah.
I think-
Okay.
yeah. Emerging, you see that spread be very, very wide, right, between cheap and expensive countries.
Well, what's interesting is this year you've finally seen some of these international markets like wake up from a just return and performance perspective over the U.S. markets. So,
Yep.
yeah.
We're hoping it's not temporary. It's a little bit more permanent.
And I just want to put up one more chart on the international thing because I thought this was interesting. This is the same chart we looked at the U.S. in the beginning. And what's interesting about this is you still see the overvaluation in growth and mid-growth, but in international stocks, like shallow value is actually relatively cheap as well. It's not just deep value in the international side.
Yeah, I mean there are differences. I mean the deep value thesis is definitely the strongest in the U.S. Right? Certainly that is absolutely the strongest in the U.S. In international markets, it's probably very strong thesis, but it's a little bit more mixed, right? And we're very cognizant of that. And if we ran the same, if we could show you the chart for emerging, it doesn't have anything in there at all, right? It's just that emerging value is cheap, but there's no difference between shallow, not no difference, but there is a normal difference between shallow and deep value.
If we look at the evaluation process you talked about at the beginning, does that change at all for international markets, or are you running pretty much the same process?
For these two ETFs, I'd say the process from a high level is very similar. And we basically look at it company by company. Obviously, accounting, different accounting is probably the biggest place where there's differences, making sure we make those adjustments and the like. We do have to make some currency adjustments. So those are more the normal things. What we don't do is we don't run separate country and currency models on top. We do use those country and currency models in other products, but it's the same argument again. When we use those country and currency models, we dilute some of that deep value exposure. And we felt that it was better to have that deep value exposure and then put constraints at the country level. And that was a better way to implement the strategy.
And how do you think about those country constraints? Is it similar to what we talked about with sectors before?
Sectors are wider, right? We let the sectors play more because there's a bigger spread in value between sectors. So sectors are wider. Country constraints are more narrow. We ideally would want to spread it across countries. And you see the portfolios across all the major countries in a large degree.
And this might be a question. This probably is not as applicable to the ETF because it's a developed market ETF. But how do you think about like specific country risks when you build a portfolio? This may be more relevant to emerging markets, but I mean we have seen some countries that had some incredibly massive issues that looked cheap going into them. So how do you think about that?
Well, I mean, historically and traditionally, this has been an emerging market issue. I think maybe that might be changing. I don't know if that's a fair thing. I don't know if that's a fair thing to say or not. Um, we try to model as many things as we can, right? So if we can model that additional, like let's say exogenous country risk, right? If we can model that, we will try to model that and we'll try to capture that, right? Let's just use tariffs for example, right? Tariffs are as exogenous risk that just came up. Nobody would have tariffs in their quant models right now or ever. I mean, maybe that'll change. I'm sure 6 months from now, everyone will have a tariff model. But what we did recently is what we would do to try to deal with those types of risks. We tried to calculate, we not tried, we did, we calculated the beta of every single stock to tariff risk, right? We use different resources from the sell side to calculate a basket for tariffs. We use text analysis from company releases. We use earnings revision and shipping data to figure out which companies have the most risk. We put all that together to form a single beta. And what all my portfolio managers do now is for every single portfolio, we're calculating how exposed are we to that? Is that an issue? Is this trade bringing us to higher exposure? So our solution to these things is one, ask ourselves first, are there exogenous risks happening right now that we should care about, that we should do something about? Two, what should we do about them? Well, ideally, we do what we did for the tariffs is we try to model it, right? We try to capture it. Like, how can we try to measure it? And then we ask, is it a big deal in our portfolio? Are we exposed, right? And that's the way we approach all these things. I mean, that's what we did during COVID. Same thing with different countries. Like we took a bigger overweight in China for COVID for the same reasons. We modeled where is COVID going to affect, who's dealt with COVID well, right? Those types of items. But these are things we're always looking out for. I think the key thing, maybe we got into the weeds pretty early. We're always thinking fundamentally about the asset. The asset could be the country, it could be the sector, it could be the stock, right? So this is exactly what we do. When the tariffs came, it wasn't about just shut everything down. It was like, how do we measure it? How do we capture it? Are we exposed? What do we, and then we can ask, what do we do, right?
Just one more thing before I hand it back to Justin. You mentioned text analysis. Are you finding yourselves using more of this advanced things, natural language processing, AI? Like, are you using a lot of that in your process now?
A lot. A lot's a difficult term.
To some extent, at least.
Well, certainly to some extent. We've been using text analysis for a long time, where we found useful, especially in our sentiment models and the like. We are certainly experimenting with different AI models, different learning models and the like. But honestly, like my attitude about this isn't a new thing. I know it sounds really weird because everyone's making it a new thing, AI and all the money flowing into it and, and the like. It's just a progression of ability, right? You started out in the old days. I mean, I remember valuation models were run on spreadsheets, right? Then you had servers that allow you to run regressions, and then you had regressions to run all these things. It's just a continued advancement along that same line, right? In my opinion. So certainly all the researchers on my team are looking at these types of techniques. So I think of it as a technique. It's a maybe better, maybe worse. It's certainly less controlled technique, right? And if they can use that technique to get better information out of the data they're capturing, or they can use that technique to get better data, right? Those are all great. And those are all things we're looking at and using, right? But it isn't one of those things where I feel like, oh, I have an AI bucket that I put as a factor. Like, we're not thinking that way. And I think a lot of people talk about it that way, which drives me crazy, honestly.
So you wrote a piece beyond China, and I think you actually have a strategy beyond China. I thought this chart would be a good, and we'll put a link to the article in the show notes. But I thought maybe to start this chart that shows China's share of U.S. imports from 2018 versus March of 2024. Can you just talk to like what we're seeing here?
Sure. It's a pretty simple chart. And what we're trying to show here is the share of U.S. imports from various countries. And so if you just read the first column, in 2018, 22% of U.S. imports came from China. 6 years later, after if Trump put on his constraints in his first term, and then Biden and his administration continued those policies, those had shrunk to 11%, right? And our premise here is like, look, people are moving manufacturing out of China for various reasons. But the reason for this chart is asking the question is, where is this manufacturing going, right? Is it going back to the U.S.? And we have another chart in our presentation books to show that it's not moving back to the U.S., at least so far. Maybe that'll change with new policies, but so far it hasn't. And where it's going is other emerging markets. So, and that was really important because that basically made this product an emerging market product. And this is once again back to the thesis of how we think of things. We look for things that are dislocated, and we think this was a dislocation in the sense that this was a big change. China has become the manufacturing powerhouse of the world. It continued to grow. Everything you buy, every piece, the phone, all these kind of things are coming from China and the like. And we saw this trend happen for many reasons, though. But the trend was people were moving their supply chains out of China. And we saw this happening, ever since 2018 even, during the first Trump presidency. But it was moving for three really big reasons, right? One, you had the labor demographics problem in China. China's getting older. Their population is out now officially shrinking. Workplace population will be shrinking quite rapidly coming up soon. And so they're not going to be able to manufacture all this stuff, right? They're going to have to, they want to move up the value chain, right? Because they're going to have less people doing these things. Secondly, I can't believe I'm bringing this up again out in 2025, but COVID. COVID was a big factor. In the old days pre-COVID, if you were a company and you wanted to buy a part, you just look, where do I buy the cheapest part for the cheapest price, the highest quality, and get it shipped to me, and I use it. Doesn't matter if it's from China, doesn't matter if it's from India, Mexico. You didn't care. It wasn't any relevant. With COVID, everyone started caring about, gee, I didn't realize that these 7 parts came from all these different places. I need to make sure where things are coming from. I need to diversify critical parts and the like. And finally, the last reason why this thesis is so valid is just the geopolitical tensions. And I'm not even talking about the recent tariffs, right? Because we ran this to March 2024, right? All of those, the geopolitical tensions, whether it's U.S. versus China, number one, number two kind of argument, U.S. Or China, Taiwan, or whether it's the Middle East, or whether it's Russia. I mean, all these things are going to cause companies to think about their supply chains. Think about, where do I need to source them, and why would I only want 1 or 2 or maybe even 3 suppliers, right?
So is the idea that the emerging markets that are gaining this export business are the ones that, are going to be more beneficiaries of this trend of moving away from China?
That's exactly what the strategy is trying to take advantage of. That's exactly what the strategy believes. That's what we believe will happen in emerging. And this is something that's very long-term and very structural. I think the reason why it's so structural is because how large China is relative to everyone else, right? I think we have a chart somewhere in some marketing slide that shows if India captured 10% of China's manufacturing electronics, right? That's not crazy. I mean, you hear about Apple moving all iPhone production, although who knows what will happen now. But you heard that Apple is going to move all iPhone production to India and things like that. So you definitely see more business that India is picking up. But it would take years and years and years and years and years of them at a massive growth rate to get to that level. And that's just to get 10% of China's share, right? So in our mind, that's the reason why we think this is going to be such a long run trend going over time.
Yeah, so it's such a big amount that, even a small amount for these other countries has a major difference to that.
And I think the interesting thing here, people said, well, isn't China going to fight back, right? Is China going to be like, this is, we have to do something? Honestly, because of the whole labor demographic issue, some of the lower end business, they don't even want, right? They're not going to be upset if 5 years from now, a lot of the low end manufacturing goes away. Are they really going to be that upset? I mean, probably not. They want to automate things, higher value added, and all the things they're prioritizing are things like solar, batteries, electric cars, things like that. A lot of the little widgets and things like that are not things that they're going to sit there and say, wow, we lost that business. So this is a place where China can win and the other EM countries can win.
And that was the one thing that sort of did surprise me with the Liberation Day and like what Trump did was like, I kind of expected the tariffs on places like China and a few other places, but then all these other countries also, and maybe they've come to the table and they're negotiating. So those are, going to be, but it's like, a Nike moved its, factories from the sweatshops in China, maybe to Indonesia or something like that. And thinking that was, or Vietnam, maybe thinking that was a way to diversify away from China only to find that, maybe there was going to be reciprocal tariffs on those other countries. But I guess, they're working through that. And yeah, it'll be interesting to see how it plays out.
Well, I think everyone has had to. Well, let's be clear. The whole tariff issue has been difficult to manage through, right? I mean, we started this fund in February of this year. I do curse people about the timing, but that's okay. But I think the real crux of all this tariff issue is really about weaponizing, tariffs as an economic weapon, right? And then once you've done that, and it's been done now. Now people have to. Now people, I mean, people like firms, companies, executives, and the like, have to think about their businesses in a much more careful way, right? Back to the Nike example. They manufacture stuff in China. Maybe they move some to, I think it's more Vietnam, but let's say they have it in Indonesia. Maybe they need to build a couple of factories in Vietnam as well, right? So in our view, in the long run, all the stuff that Trump has done has actually only made this thesis stronger, right? Because now every executive can't sit there and say, I have two places I want to put things. I'm getting my two critical inputs. I've diversified. I've done my job. Now they got to say, well, what happens if the second place gets punished or weaponized against and the like? What happens in that scenario, right? So the thinking there is that you're gonna try to find low cost suppliers of high quality goods, right, or supply or inputs, and you're gonna have to diversify more, right? The incentive to diversify is even greater because of the weaponization of tariffs as an economic weapon.
I noticed in your long-term return forecasting chart, you had two bars for each of the asset classes we looked at. You had a normal interest rate environment and a low interest rate environment. So I'm just curious, do you think these changes that are happening globally with trade are, could lead to longer term, sort of maybe more stubborn, higher inflation than we've seen in the past?
I mean, I'll kind of say what I said earlier. I'm not a big person on predicting rates and the like. Certainly not my cup of tea. I mean, certainly that's probably the I won't say standard, but the consensus that these things are not going to help rates long term. They're gonna any frictions you put in the marketplace will result in higher prices, right? And with more. And these are definitely frictions in the marketplace. Now, like I said, I think the problem with that analysis is you're predicting that this whole tariff thing will continue. What happens if he cuts the deal with everyone and it goes back to normal, right? So in some sense, you have to ask yourself the first question, right? What is the steady state in the long run, right? Is that steady state that we're going to have this like 15, 20, 30% tariff across the board all the time? Then that friction will always be there, right? So I think that the problem is the first question is really probably the most important. The other stuff will fall out from it.
Yeah, that's fair. Okay, we have two standard closing questions we like to ask all of our guests. The first is, what's the one thing you believe about investing that most of your peers would disagree with you with?
Yeah, I struggled on this one. I don't talk to my peers about myself. That's probably one reason. I'm not sure if my peers would disagree with me in words, right? But I think their actions, I think, do. And I think the story I find frustrating is you have a manager and they have a drawdown. And this happens in my team as well. You have this drawdown, and the immediate question is, we got to do research. We got to fix the problem. And that's what they do. They do this research. The research gets done, and effectively, in more eloquent terms, the problem gets fixed, right? And sometimes this is true. Sometimes, maybe you weren't running the model the right way, or maybe you weren't capturing the signal in the right way, and you need to fix it. But I think so many people don't spend a lot of time on the most important question is it really a problem? Is it really a problem that you had this drawdown, right? Because the markets do weird things sometimes, over 1 month, 3 months, 6 months, whatever it is. Like, were you capturing this? Is the signal you're capturing what you wanted? Were you capturing the signal in the right way? Were you modeling at the best of your abilities? Is the questions I feel like people don't ask a lot of times. Like I get this with young researchers all the time. They come in and go, "Oh my God, we underperformed. I got the signal that's going to fix it." And I'm sitting there going like, well, and maybe they're right? I'm not saying they're always wrong, but I say, well, why don't you sit down and tell me ex ante why we were wrong? Why is it a problem? And I think that's what I spend a lot of time with my team about. And I'm not saying that other peers wouldn't say the same thing, but I don't see it as often as I'd like, if that makes sense.
Yeah, it does.
It is funny though. You don't see too many growth investors right now, like digging deep into their process to see what they could change about it. It's like when things are going well, people tend not to do it, and when things are going poorly, it's the opposite of what we should be doing, though. Probably
it's human behavior, right? It's just keeping the pedal on the metal all the times, and that's kind of the thesis that we try to get out there. But it's hard. It's human behavior. Certainly, we're subject to it as anyone else, and I know when we perform better, people will. You got to push them. You actually have to push them harder when we perform better. Yeah, you have to throttle them back when we underperform. Actually, that's usually what happens.
And the last question is, based on your experience in the markets, what's the one lesson you would teach your average investor?
It goes back to my philosophy around all things, whether it be stocks, investments, people, and teams. My philosophy around that is you identify what you do well, right, and then you leverage that ruthlessly, right. That to me is super important. Like you don't want to be. I mean, unless you really are just good at all things, and maybe that's your competitive advantage, but you have to identify that competitive advantage and just ruthlessly execute on that, right? In our sense, what we do and what we feel is around fundamentals, around valuation. Those are the things we're trying to leverage, right? We're not trying to be all things to all people. You mentioned the AI component, everyone running their own like short-term AI StatR model. We're not doing that. We're not interested in doing that because we're probably not going to be that good at it, right? So, and I can say whether it's talking about an investment, you're talking about a person, you're talking about an employee, I feel like that's the most important thing, right? If you're an investor, leverage what you're good at, right? Try to figure out, am I good at identifying, talking to management? Am I good at reading the analyst reports? Am I good at just watching charts? Maybe some people are really good at that in reading charts. To me, that's more important than trying to do catching the trend of what someone else is doing. Right. And I think that's the most advice, because sometimes people get caught up in what's going on in the market. Like, oh, everyone's doing this. Well, I need to go do that. And that's not a great approach, in my opinion.
Great, Warren. Thank you very much for joining us. We really appreciate it.
No problem. Thanks again for having me.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.